Hello, everyone, and thank you so much for joining us on the webinar on macroeconomics. I am Tanvi Kanchan, Head of Strategy and Vice President at Anand Rathi, and I would be your host for the evening. We have with us Mr. Sujan Hajra, the Chief Economist and Executive Director at Anand Rathi. Mr. Sujan is a top-rated market economist, a macro strategist, and the head of research. He previously was the director in the macroeconomic research team at RBI. He has represented India in some of the forums like G20, IMF, WTO, UNCTAD, and so on and so forth. He has been a part of various official committees and groups. He has also authored research articles. He is a regular contributor to print as well as electronic media. He is an all-time topper at UPSC IES 1992 and the RBI recruitment test at 1992, as well as a topper in MPhil and top 5 during his MA. I would like to hand over the webinar to Mr. Sujan to take this forward. Sujan.
Yeah, hi, Tanvi. Thanks for your introduction. A very good afternoon to all of you. We really appreciate you joining us today. So, as Tanvi mentioned, that we are starting this is a series which we do every month. This is the second of the series which we are doing. So without further ado, what I'll do is that I'll share a presentation with you and take you through this presentation. The main point which we are going to discuss today is, as the name suggests, that there is a lot of uncertainty right now whether the equity market from here is likely to go up, go down, what you should do with your portfolio. So there is basically a lot of information overload. You are hearing various views, various data points are indicating various things. So what you should do with your portfolio, we are going to try to give you some perspective on that. Now, if you look at since the end of 2019, say if you look at the Nifty since the end of 2019, the Nifty had gone above 12,000 during that time. Then it corrected. These are all the month-ending numbers. So while in March, Nifty had actually hit somewhere close to 7,500, you will see the end was 8,500. So that's the kind of number. But the point which I'm trying to tell here is that the market corrected very sharply in March 2020. And since then, the market has gone up very substantially. But if you look at since August this year, the market hasn't gone anywhere. In fact, it had gone to 18,500 kind of level Nifty. And from there, the market has come down to the current level. So now the question which really comes is that, is the market likely to go up again? Is it likely to correct? If it's going to correct, is it going to correct by a large margin? So therefore, whether you should increase your equity allocation in your portfolio, decrease your equity allocation in portfolio, maintain the same allocation in your portfolio, what are we recommending and why are we recommending that? Before we come there, really, if you look at in terms of your equity, how those are the equity levels, what are the kind of equity return which you are making? Again, this is the month-end number. So if you look at while the equity return had turned negative last year, as much as 20% minus 20%, by March this year, this return was 70%. So, but since then the return is coming down, and as of yesterday, your 12-month return was just 26%. So clearly the return has come down. And so far, what we are talking about, this is history. But going forward, where are we seeing the market going? What are our advices? To you going forward? So that's what we are going to discuss. To do that, we are actually splitting this presentation into 5 smaller parts. The first thing which we are going to address is the most important question: Do we expect a large correction? basically how is the likelihood that there can be a significant correction in the equity market in the near term. The second thing, there are a lot of policy changes which people are talking about. One part of it is the liquidity withdrawal, interest rate hike, and things like that. That is linked to inflation. So that's something which we are going to discuss. But even otherwise, there are other policy issues. For example, the US-China relationship is not particularly good. There are a lot of tension going on. China is slowing down. So what will happen there? So those kind of, whether the policy risk in itself can bring the market down, or the inflation, if the rate hikes start, if the liquidity withdrawal start, will that have a major negative impact on the equity market? We'll discuss that. Also, what we'll discuss is that in the specific context of India, as we saw, the market has gone up very substantially. Even if the market has come down from say 18,500 to 17,200 kind of level, we know the market has gone up more than 1,000 points. Nifty has gone up more than 1,000 points from 7,500 in March 2020 to the current level. So given that the market has rallied so much, is it that also the economy has done so well? Or is it that the market is going up and the economy has not done so well? So that's also something which we'll discuss. So these four are the topics which are directly linked to equities. But the last thing which we are going to discuss, what's our perspective on real estate? Because people are looking at real estate increasingly as an alternative to equity market. Real estate has done pretty badly from 2016, but now there is a lot of hope that while the equity returns will come down, perhaps the real estate sector will do well. And so therefore, is it a good time that you should start increasing your allocation in real estate? That's also something which will try to provide a perspective. Now, starting with the first topic, that is how likely is the big correction? Here we are going to talk about touch upon 5 things. First thing is obviously there has been a huge rally, and after such a huge rally, what generally happens? We are going to see that, is it that after a big rally the market corrects big time? Is it that after a big rally still the market goes up subsequent in the next 12 months, in the next 1 year? That's something which you are going to look at. Second, what we are going to talk about, what is happening to the valuation? Are the equity valuations too costly? So if they are very costly, is it likely that the market will bring down the market? Similarly, what is happening to corporate earnings? We'll touch upon on that also. Another thing which you have seen, that generally if you have a good year in equities, the next year becomes a bad year. If you have a bad year, the next year becomes a good year. So now we had a very good year last year. So is it that we are going to see a bad year? We will try to give a perspective. One thing, while even now, as of now, as I just showed in the previous slide, you are getting 26% year-over-year return on equities. Obviously, this kind of returns are not sustainable. But what should be your expectation? How much you could expect realistically that the next 12 months, what is the kind of return you might be able to make in equities? We'll talk about that also. Now, let me start with the bad news. Now, what we have done here in this chart is that we have taken the daily Nifty data from the start of 2010 till yesterday. Now, say, as you know, roughly in a year, there are 250 trading days, and we are talking about almost 12 years. So somewhere close to 3,000 data points we have here. We have split these 3,000 data points into 5 equal parts. So in each part, there will be about 600 data points. So the bottom 20% of the data. So if you look at the bottom 20% of the data, this is what is the last 12-month return. So average return is minus 10.5%. Next 20%, the average return is 3.3%. On contrast, the top 20%, the highest return period, the average is 35%. So we have split the last year return into five equal number of observation bucket. Why have we done this? We want to see if the market has done very badly or very well in the last 12 months, how the market behaves in the next 12 months. So what you'll find is that if the market does the very badly, the next 12 months, the market does extremely well. So while the previous 12 month, the worst 12-month market on an average has resulted in 10.5% correction, in the next 12-month market has given almost 22% return. Now, depending on how good or how bad the market has been in the last 12 months, if you see as the market returns keep on increasing, the return for the next 12 months actually keeps going down. Now, right now, as I said, in the last 12 months, the return has been about 26%. So we are between high and very high return in terms of the last 12 months. So if you go by the past data from 2010, you can expect anything between 2 to 6% return in the next 12 months. So that's the bad news. If you go by the numbers since 2010, realistically, you can get 2 to 6% return in the equity in the next 12 months. So that's the first bad news. The second bad news is that, see, any point of time, if you are investing, and you are holding that investment for 12-month period, on an average, if you are investing 100 rupees today, and if you are holding on this investment, you are not selling, you are not buying any further for the next 12 months, almost 25 to 30% of the cases, you will see that your investment has gone down. That means the value of your investment after 12 months becomes less than 100. On 75 to 75%, 75% cases, the value of investment goes up. But on 25-30% cases, of your value of investment goes down. That is, you suffer a capital loss. That happens. That's the as we know, equity market is volatile, and this is typically what happens in over the years. You have seen this kind of trend. Now, again, if we do the same exercise from 2010 onwards, again we split it into 5 equal parts, and if we see what is the percent. So if the last year was very bad, only in the 1% case, the next 12 months you will see any kind of capital loss. But if the last 12 months return was very good, in almost 40% case, next 12 months, you will see capital loss. Now, again, we have seen 26% return in the last 12 months. So going by the past data, there is a 30 to 40% chance that you can see capital loss in the next 12 months. So we are starting with a couple of bad observations. One is that given the current phase, 2 to 6, going by the data since 2010, 2 to 6% equity return in the next 12 months is something what you should expect. And there can be a 30 to 40% possibility you will actually end up with a negative return on your portfolio. Your investment value of your investment can go down in the next 12 months. But there are reasons to explain, reasons to tell you is that 2010 to 2021 is not actually very normal period. So whatever the things which I talked about may not be particularly relevant for the next 12 months. Why am I telling that? Now, if you look at the 2010 to 2020, now why I highlighted all these things? Because this is exactly what people are talking about. People are telling that going by the past, there is a chance that the market can come down significantly. But I'm trying to explain why that argument is not particularly strong. So if you look at the last 10-12 years, there have been lots of negative developments. For example, as you know, in 2008-2009, there was a global financial crisis. So there was a serious impact on the economy, but government came out with a lot of stimulus and things like that. So by 2009-2010, the economy started reviving again. But after reviving, the economy started going down again, what we call a second dip. So between 2011-12, we saw the growth across the world, also in India, started correcting again. Then if you look at 2012 to 2014, that is last leg of the UPA rule, we generally call this period of policy paralysis. Not a lot of things are happening during that period. But after that, we got a majority government. There was a lot of euphoria in the market and things like that. But if you look at in 2016 and 17, The new government introduced 5 major reforms almost simultaneously, starting with demonetization in November 16, then introduction of GST, then real estate regulator, then insolvency and bankruptcy code, then the banking sector reforms. Now, these reforms combined resulted in a lot of disruption. Also in 2018, if you remember, DHFL and ILFS went bankrupt, and that sent shockwave through the financial system. The financial markets got very seriously impacted. And then 2018-19, there was trade war, US-China trade war. So if you look at the whole of the decade, there are lots of abnormal things which are happening, which doesn't happen normally. So don't just go by what has happened since 2010. Let's try to take a slightly longer term view. And if you take a slightly longer term view, the outlook becomes different. Say here we are taking data rather than from 2010, we are taking data from 2000, and we are looking at the same exercise here. Here also, what is the last 12-month return, very low, low, average, high, and very high, and what is the corresponding 12-month return. Now, as in the case from 2010 onwards, if there is a very bad year, the next year generally is good. But what is different here is that even if it was a very high or very high return in the previous 12 months, that does not mean the returns will be extremely low. For example, in case of high, there was the next 12-month return was 9%. In case of very high return in the previous 12 months, the next 12 months return was almost 14%. So we are here about 26% return right now. So we can realistically expect 9 to 14% kind of a return in the next 12 months. And on the top of that, again, if you look at in terms of the risk of capital loss, going by this long series data is anything between say 25 to 30%, which I said at any case is the average risk anybody carries if one is investing for 1 year. So 9 to 14% kind of a return, average risk of capital loss. So the situation may not look does not look particularly alarming. But having said that, this is just in terms of the numbers, how it has behaved in the past. What about valuation? Isn't that because of the strong rally, the valuation of Indian equities have gone up, and whenever valuations go up so much, that means equity that might result in equity return coming down. That's absolutely true. Once again, we have we are taking the data from 2000 and we have split it in terms of different levels of valuation, very low valuation to very high valuation. These are the P ratios corresponding to that. And if you look at when the valuations are low, the next 12-month return is very high. And when the valuations are high, the next 12-month returns are low. So basically the valuation, the Nifty valuation today is somewhere close to 24. So we are pretty much close to here. Now, if we go by this data, then you should expect a 3 to 4% only in return in the next 12 months. That's what the P data is suggesting. But once again, what you have to understand, so what is this P data is trying to say is that if the valuations are low, generally the returns are high. Now, if you look at in the equity market, there are basically two types of investors. One are called value investors, who invest if the stock prices are low. That's value investing. Or not only stock prices, stock valuations are low. There is second type of investors who are called growth investors. They try to invest in companies who have much superior growth expectation, but not necessarily they are cheap. They are not, their valuations may not be low, but they have very strong growth prospects. So value and growth, these are the two types of investors. But many a times the value and growth are interlinked. For example, while I showed that if the valuations are low, then next 12-month returns are high. But if you look at on the same data, the valuations are low because during that period, the earnings growth are very high. Now, what is P? P means P is price and E is earning. Now, for example, if Nifty, for simplicity, let's assume Nifty is at 20,000. So the P is 20,000, and let's assume the earnings per share for Nifty is 2,000. So you divide 20,000 by 2,000 and you get a P of 10. So that is what is P. Now this, rather than being 2,000, if the earning was 10,000, if the earning was 1,000, then the P becomes 2,000 divided by 1,000, 20. So the P becomes high if the earnings is low. If the earnings growth is high, then the P becomes low. So basically, I'm showing you that actually the P ratios become low if the earnings growth is high. So here is the convergence of value investing and growth investing. But the more important point, what I want to tell you is that if you look at the P ratio of the Indian market, here we are looking at P of Nifty 50. If you see over the years, the P ratio has gone up. The average between 2000 to 2005 was less than 17. The average between 2006 to 14 was close to 20. And the average since 2015 till date is about 26. So you clearly see the P ratio of the Indian market has gone up over time. So that might give you the impression that increasingly Indian equities are becoming expensive. Their valuations are going up. And if the valuations are going up, they are not becoming, their attractiveness is actually going down. But that's not necessarily true. Now, let me try to explain to you what I'm trying to say here is. So when you look at Nifty 50, you think it's just one uniform index, but it's not one uniform index. The composition of Nifty 50, the stocks, there are 50 stocks, but which are those particular 50 stocks? That number changes over a time. For example, if you look at just from 2000, if you look at the number of the stocks which are part of Nifty 50 in 1995, when the index first started, only 9 of those 50 companies are still there in Nifty 50. 41 has gone out. And if you look at over the time, 130 plus stocks have been part of Nifty and they have been dropped also subsequently. So basically what I'm trying to say is that while we call it Nifty 50, the composition changes over time. The exact stocks which are there in the index, that changes over time. That impacts the index. See, for example, if you look at the sector-wise weight in the index, say for example, financial, which include banks, NBFCs and all, that has the highest weightage. Now, if you look at since 2011, the weightage of financials have varied between 25 to 40%. IT has varied between 12 to 19%. Oil and gas has varied between 8 to 16%. Now, what happens basically is that the sectors which have lost weight over time are utilities like power and all, industrials like cement, capital goods like that, and materials, basically metals. Now, these are the kind of stocks who has generally very low PE. Whereas the stocks like banks, IT, FMCG, they have very high PE. So you are excluding the stocks which are lower PE. You are including the stocks which have higher PE. Consequently, the index PE also goes up. So it's not, in the previous slide, I showed you that the Nifty PE has gone up. It's not because Nifty has become more expensive. It's because the kind of stocks which are now included in Nifty, they are more, they intrinsically, they are from sectors where the PE ratios are higher. So it does not mean the valuation of the Indian market is going up. So what is rather than looking at the PE over a time, what is more important, what is more appropriate? You look at the current valuation as compared to the valuation in the last 5 years. Because if you compare it with last 10 years, 15 years, 20 years, then that becomes a difficult comparison because index has changed a lot. Now, if you do that comparison, so here what we are seeing is that we are looking at the current P, how much above or below it is from the last 5-year average. And going by that, if you look at when the P difference is high, that is the P is relatively low, then you get higher return. And when the P difference, that is the current P is much higher than the last 5-year average, then the returns become low. Currently, as I said, the Nifty P is somewhere close to 24. The average for the last 5 years is 26. So we are at -2 kind of a level. So given that -2 kind of a level, 18%, 19% return is pretty much possible given this scenario. Now, I have given you different data points. Now, I just want to conclude and what is our view. First, the question is that is the big correction is likely? We don't think, see, as I said, a 25 to 30% chance always is there that the market in the next 1 year will give you a negative return. That risk remains. But going by the other data, for example, if you look at in terms of valuation, if you look at in terms of long-term trend, if you look at earnings growth, all those things, none of these are giving us a clear hint that this market is going to correct very significantly. Yes, one thing which you are clearly getting from here, that you are not going to get the kind of return which you have got in the recent past. So even now you are getting a 26% return. It's obviously you are not going to get return anything of this sort in the next 12 months. On the lower side, the worst case example which we saw is 2 to 5% kind of a thing, and more likely case is about 9 to 14% kind of a 12-month return is something which is pretty much likely, which can happen. So that's the kind of expectation we should maintain. But you should also understand there are certain risks to this market. And when we come to the second topic, we are going to talk about the policy risk, which includes the geopolitical risk. For example, the kind of tension between US, China, we are talking about that. There is a slowdown happening in China. You know, the Chinese real estate sector is doing very badly. We are including those kind of impact. The supply disruption, for example, you know, the microchip shortage is happening. The ships are not being available. The ports are getting clogged. All those supply chain problems we are talking about. There is a lot of protectionist trend out since the pandemic, because the global supply chain was disrupted. Now countries are trying to create their own supply chain. So they are trying to relocate industries in their own territory. So there is increase in protectionism there. And of course, the commodity prices have gone up pretty significantly. So these are all kind of risks. Now, rather than looking at each of these risks separately, what we have done is that we have used a risk measure. Internationally, the policy risk of different countries are measured by a particular agency. We have used that measure, and we have tried to see if these risks are high, very high, high, average, low, or low, very low. What is the corresponding level of equity return? This is for US, which you have done. So clearly, if you see if the risk goes up, equity return goes down, and at the highest level of policy risk, the equity return becomes a negative. This is in the context of US. Similarly, we have looked at the thing for China. In case of China, in case of US, the equity return turned negative at very high policy risk. But in China, in high policy risk itself, it turns negative. Interestingly, it becomes positive when the risk is very high. This is because China has a typical characteristic. In other countries, the government does not invest, or the government agencies don't invest directly in the equity market, but in China, they do that. So if there is very high policy risk, there is a support from the government to the equity market, and that's why equity return becomes a little bit positive. In case of India, again, the same relationship as US. As the risk increases, equity return goes down and turns negative. Now, what is important to understand, what is the situation right now? Now, if you look at the situation right now, the risk in US is high, the risk in China is high. but risk in India is low. And these are the corresponding numbers of the equity return. So despite the risk being high, in US, you are seeing a 16.5% return. Now let's go back and see in normal situation, if the risk is high, US, the return should not be more than 8.5%. And in fact, in the best case scenario, when the risk is very low, then the average return is 16%, while US already is getting a return of 16.5%. So clearly there is a disconnect between the policy risk in US and the kind of equity return which they are generating. Same is true for China. They are getting a 5.5% return. But historically, if you look at, if the risk is high, they generally get a negative return. So there is a misalignment between equity and the policy risk. In case of India, India is the only place where we are seeing that the risk and return are more or less linked. These returns are month-end returns. So this is not as of yesterday. This is as of end of November. So if you compare India's, if the risk is low, or 26% on an average 26% kind of a return, and here we are seeing a 29, actually the 29% return. So in case of India, the risk and return is pretty much aligned. So our conclusion is that if the policy risk is there for the equity market, but it's not so much coming from India, it's coming more from US and China. So the big question, the conclusions from this side, the policy risk is elevated in US, the policy risk is elevated in China, and it's pretty low in India. So, and since there is a disconnect between equity and policy risk in US and China, it's quite possible that that can impact the equity market, and if that impacts other countries' equity market, it will also have impact on India. But having said that, since India is more or less aligned with the fundamental, if Indian market corrects because of the global factor, there is a very huge possibility that Indian market will actually recover pretty fast, and India can regain the position pretty fast. Similarly, separately, we are looking at the risk of inflation. Now, why are we talking about inflation? Because everybody else is talking about inflation. They're talking about US is going to the tapering, they're going to withdraw liquidity, they are going to increase interest rate, and the inflation might remain elevated in US. So all this negative impact, this can impact the equity market in various channels. First of all, if the inflation is high, that means the cost of input and everything goes up. So the profitability of the corporate sector comes down. If the inflation is high, then that destroys income of the households, and therefore there is demand destruction. Similarly, high interest cost also impacts the corporate. The future return falls, and that reduces the valuation of the company. So there are various ways in which high inflation, high interest rate can impact the equity market. But having said that, if you look at in actual practice, this is in the context of US. Here we are looking at the different levels of inflation from very low to very high, and corresponding equity return. If you look at, there is not so much of impact of inflation on equity return. Only if the inflation is very high, incidentally, inflation is very high in US, then there is some level of equity market correction. But in contrast to US, if you look at in case of India, as inflation goes up, actually equity return also goes up. That looks pretty strange, but there is a reason why this happens. There are various reasons. I'll give you one important reason why it happens. Because when inflation goes up, corresponding banks also start increasing their interest rate. But if you look at, in general, banks don't increase their interest rate as much as the inflation goes up. For example, between high and very high, inflation is going up by more than 3 percentage points. Banks just increase their interest rate by 40 bips. Similarly, between average and high, the inflation is going up 2 percentage points. Banks increase the interest rate by 20 bips. So banks don't pass on as much. Consequently, what happens is that as inflation goes up, the real interest rate actually comes down. So real interest rate is actually the highest when the inflation is very low. So because your effective interest cost actually comes down, that's one reason why when inflation goes up in a country like India, equity market actually starts performing better. So net, what do you think? While the overall policy risk is a major issue, inflation we don't think is a major issue. First of all, inflation generally doesn't impact the equity market so much, even in US. In India, actually, the relationship is that when inflation goes up, equity returns actually go up, and real interest rate comes down as inflation goes up. So we don't see a major risk coming from inflation. Lastly, on the equity side, what is happening on the macro side? So there are a lot of feeling that the economy has not recovered so much. There are lots of weaknesses. Still the market is going up. Is that perception right? What we have done here is that we have compared the Indian economic performance during the calendar year 2021 with 2000 in the average between 2015 to 19, that is before the pandemic. We are just leaving out the whole of pandemic period, and we are comparing what is the highest level in 2001, comparing it whatever is the highest level between 2015 to 19. Now in GDP, if you look at uh, government consumption is 5% currently, post-pandemic, 5% higher than pre-pandemic. Investment is 9%, and all these are in real terms, 9% higher than pre-pandemic. Overall GDP is 5% higher than pre-pandemic, and industrial production is 6% higher than pre-pandemic. The areas where there is some amount of problem is private spending, so private household spending and services. And agriculture also shows it's down, but in case of agriculture, actually the biggest amount of comes in the after the Kharif, that is the December quarter is the number which you should look at. That number has not come this year. That's why it's showing this kind of a dip. Agriculture actually is doing reasonably well. In the foreign trade also, if you look at, exports are 9% higher post-pandemic. So in terms of most of these indicators, if you look at, the situation is significantly better now than before the pandemic. Similarly, if you look at other areas, for example, fixed deposit rates are almost 40% lower now as compared to before the pandemic. Lending rates are 20% below what was there before the pandemic, so which is actually a good thing. Bank deposits are up 20%, lendings are up 12%. Inflation is up, which is of course not a good thing. Similarly, the government has, despite the government spending a lot, the fiscal deficit has come down. Government spending itself has come down very high of last year, and government tax collection is actually up. So if you look at, in terms of all these indicators, most of these are also post-pandemic. Right now, we are doing much better than before the pandemic. But there are some areas where we are not doing so well. If you look at the whole automobile, the cars and two-wheelers, aircraft movement, air passenger traffic, air cargo traffic, petrol use, these are still much lower than what was happening before the pandemic. Whereas the job market is doing pretty well. If you look at Naukri jobs index or the data from Employees Provident Fund, there the job creation is going on very strongly. If you look at the IT and other sectors, the employments are at record high. Electricity use, gas use, all these things are showing that currently we are at a much better place. So net, if you have to conclude from here, for most part, the economy has recovered much better than before the pandemic. There are foreign trade is doing very well. The job market is doing well. Government income has improved significantly, and if required, government has the ability to give more impetus to the system. But having said that, there are some parts of the economy, for example, auto, for example, transportation, passenger transportation, as well as cargo transportation. Those areas, there are still some problem. But at the overall economy level, there has been significant improvement. The last thing which I'm going to talk a little bit about is the real estate. Now, RBI publishes a data on the real estate prices. So clearly, if you look at for real estate sector, 2011-12 was very good year. Annualized that there were capital gains to the tune of 25% of in each year. Between 13 to 15, almost every year, 15% kind of a gain. But since then, the situation has turned pretty negative. If you look at in the last 2-3 years, particularly, there has been a very subdued kind of real estate situation. So while we are just not looking at RBI data, we are also looking at NHB data. And in NHB data, that is National Housing Board, they additionally what they do, the ready to move in property and under construction property, they give a breakup. Interestingly, if you look at earlier, until recently, this is ready to move in properties are doing better than the under construction, particularly after RERA. So basically, if you look at ready to move in property, generally are the end users buy the ready to move in, while in under construction, a significant part can come in the form of investors. So the investors in real estate actually had evaporated earlier. That's why if you look at the ready to move in was doing better than the under construction projects. But in the recent, if you look at the ready to move in, the direction is going down, and under construction, the direction is moving up. So this prima facie indicates that some amount of investor interest is coming back in the real estate sector. But having said that, still, if you look at the return ratios are not very impressive. So in the next couple of years, they might not, real estate might not do so well. But having said that, we think the worst is behind us so far as the real estate is concerned. Lastly, if you look at the real estate, obviously, you cannot take a all India view. You have to look at city-wise, state-wise, and things like that. With the notable exception of Lucknow, if you look at in the real estate sector, actually North has done relatively badly, as also Chennai. In contrast, West and South has done relative. These are the annualized return between 2010 to 21, and this is for the latest quarter. So here also, if you look at Kochi, Bangalore, Ahmedabad, even Mumbai is doing much better than the all India average. Whereas Delhi or Chennai or Kanpur, they are still lagging. So I don't know. So net, what I want to tell you is that perhaps the worst is behind the real estate, but in the next couple of years, next 3 years, real estate returns are unlikely to be very high. West and South is doing relatively better than North. There is early signs of investor demand coming back in the real estate. But having said that, in the real estate, the biggest problem which will continue is that availability of large inventory, ready to move an inventory, that will sort of keep the prices anchored. So that's it. What I wanted to cover. To sum up, 4 major points which I want to make. Chance of a large correction in the equity market, we don't think it's very high. Whatever risk which you are seeing, not so much of risk from the India side. There are risks coming from China. There are risks coming from US. So those kind of risks are there. And as we said that in US and China, the equity performance and the risk perception are not totally synchronized. So that can result in some kind of correction, and that might impact India also. But having said that, since in India, the risk and return are well balanced, if that kind of correction in India happens, that will be short-lived, and there will be opportunity to buy rather than sell. Our sense is that ballpark 10 investors should trim their expectation from equity market to somewhere close to 10%. So far as real estate is concerned, we think still real estate, while the worst is over for real estate, still it's not looking a very attractive asset class as of now. So I'll stop here, and if there is any question, I'll be happy to take those. Over to you, Tanvi.
Thank you so much, Sujan, for such a detailed presentation and update on the entire macroeconomic part. So we have one question by Ms. Suman. She wants to understand how India's overdependence on USA or FIS can be reduced. Recently, we saw a lot of selling by FIIs, which dragged the indices down, even though the US markets were positive. So she wants to know your opinion on this particular
Sure.
point.
Now, this is right that we have significant dependence on FIs. Let me tell you in terms of numbers. If you look at the ownership of the Indian equity market, say about 50% of the Indian market is owned by the promoters. Now, that is so. Let's now concentrate on the non-promoter part of it. So, out of the non-promoter part of it, about 70% is owned by the institutions, and about the rest 30% is owned by individuals, the retail investors, HNIs, and all of them together. Now, out of the overall market, about 20%, 21% is owned by foreign institutional investors. So in the non-promoter part, their ownership is almost about 40%. So obviously that is pretty substantial. But if you look at Indian institutions, whether it's mutual fund, insurance companies, banks, they together also own 15% of the market or 30% of the free float. So 40% of the free float, that is non-promoter part with FIs, 30%, slightly more than 30% is with the Indian institutions. So already if you look at, we are closing in with the foreign institutional investors. The difference is not much. Over time, the ownership of the retail has gone down, but that of the Indian institutions as well as foreign institutions have gone up. So this is one thing. This is one thing which is happening. And particularly, we are seeing that the ownership of the mutual funds have gone up significantly in the last 3-4 years, which is a counterbalancing thing. Now, see, FI ownership is not necessarily a bad thing. First of all, you have to understand that it's not that if FI sell, the Indian market goes down. The relationship is the other way around. FIs buy in the Indian market when the prospect of the market is high. When the market returns are high, they invest in the market. When the market returns are low, they leave India. So it's not that the FI money results in the market going up or down. The market going up and down attracts or deters FIs from investing in India in terms of mathematical causality test. That is the relationship. Now, what do you think? What do you think is that obviously, I take your point that there is significant dependence on FIs. We should actually create the domestic equity culture more. For example, we should, the mutual fund Sahi Hai campaign, all those things. So investor education, they should realize that equity is the best performing asset class over time. And if you invest in the longer term, the risk is lower. So this kind of investor, already the Indian households, their exposure to equities just about 2-3%. Whereas if you look at globally in many countries, the portfolio allocation into equities goes into 20-30%. So we should concentrate on increasing the allocation of the households in equities. So that will be the effective counter to the over ownership of FIs. Back to you, Tanvi.
Thank you so much, Sujan. I hope that answers your query. We have another one from Mr. Mehta. He's asked that right now the WPI is somewhere around 14.23, and it's a worrisome figure. And what is your thoughts on the inflation going back to the normal average of 11 to 12%? Do you see it coming down anytime soon in the future, or these are the kind of inflation numbers that we are going to be witnessing in the coming future?
Now, first of all, why there is, as you know, the CPI inflation, the retail inflation is somewhere close. Retail inflation is somewhere close to 5%, while the wholesale inflation is somewhere close to 14%. 14%. Why so much of divergence is there? Now, why this divergence is there? One major reason is that when we look at wholesale prices include only agricultural and industrial products. It does not include services. Why wholesale price does not include services? Because there is no wholesale market for services. Say, for example, we cannot have haircut in the wholesale. For example, we cannot take rent wholesale. So that's why the wholesale price index only has agricultural and industrial products, not services. And whereas services is a significant part in the retail inflation. That's point number one. Point number two, that there is a significant difference in the relative weight. For example, in the retail basket, the weight of food is very high. Food is almost 50% of the retail inflation. Now, the food inflation right now is very low. Food inflation is just about 2%. And non-food inflation, on the other hand, is much higher. So that is another reason why with much higher weightage on food, the retail inflation is much lower. Also, what you have to understand that during the pandemic, while the retail inflation was going up, it moved from 6 to 8%. Wholesale inflation was actually going down because the wholesale markets collapsed during that period and it turned negative. So there is a base effect also in the wholesale inflation. Having said that, a 14% inflation is pretty high. But with the global commodity prices coming off, we are already seeing that the copper, silver, all those prices are coming off. So with that, and now the high base going forward, we think wholesale inflation will also come off. But in contrast, my sense is that for the next 3 months, you will see the retail inflation will go up. Perhaps it will cross the 6% mark. So my sense is that going forward, eventually we'll see that WPI inflation will move downwards, while retail inflation will move between 5.5, 6% kind of level. So this is the kind of trajectory for the next 12 months which we have on the inflation side. Back to you, Tanvi.
Okay, thank you so very much, Sujan. We have another question regarding, sorry, regarding investment banks favoring China. So, what are your thoughts on the favorable part, which is the funds that are flowing into China, and will that affect or have any kind of trimming their exposure in the Indian markets? If you have any views on the same.
Actually, Chinese equity market has been one of the worst performing market among uh, uh, until recently. So there was so China has underperformed all other markets, while Indian market has outperformed. In fact, until recently, India was globally the best market in terms of 1, 2, 3, 5, and 10-year return. Even now, India remains one of the best market in terms of these returns. So obviously, since Chinese market has underperformed, there is some level of interest going back into China, but we think that the Chinese economy still is under a lot of pain, partly from the property sector, partly because the kind of policy changes they are doing. In fact, with the exception of semiconductor and what we say, the technology companies, the Chinese market is also doing pretty badly. So I think here clearly the China plus one strategy is helping India rather than people moving from India to China. So I think China is more of a risk from a possibility of disorderly correction rather than China outperforming. So I think the risk from China is rather the other way around, rather than China taking away investments from India. So that's my view. Tanvi, back to you.
Thank you so much, Sujan. I think that's it for the day. Thank you everyone for joining in on our monthly economic call. Thank you so much, Sujan, for taking the time out and addressing all of our clients and live on everyone who joined in on Facebook. Thank you everyone and have a great weekend. Thanks a lot.
Thank you everybody.